Right, Mayuresh Joshi from Angel Broking is also joining us now. Mayuresh, good morning. First up, on the markets, looks like there is a turnaround in the pharma stocks. There is a demand for IT stocks here, and also PSU banks have started to move. So how durable is this move? Are we seeing a good turnaround? Are you actually now finding some real opportunities in pharma stocks?
Supporting Piyush, I think the entire trend and sentiments towards pharma stocks has taken a U-turn, and a large element in terms of what kind of an earnings upgrade you might see FY20 onwards looks plausible on the cards at this point of time. So the resolutions for FDA-related issues for all the pharma companies which are possibly facing that should start ebbing off in the second half of this fiscal. And pharma companies with a very strong specialty pipeline with strong FTFs, I think these are companies who can actually overcome the pricing pressure issues in the US markets. So you're probably going to see some amount of earnings upgrades come through. A few companies probably have already indicated, for example, Sun Pharma did indicate that the second half you will see double-digit growth. So valuations from a near-term perspective do capture the kind of price rises that we've seen. But I think stock-specific action from a medium to long-term perspective is still seen not just in pharma but even in the IT space.
Right. Mayuresh, you said action is going to persist in the IT space, and then in that case, who would you be sticking with in the IT counters? Would it be the Infosys, TCS, the frontline names, or would it be the second line names such as the Tata Elxsi, KPIT, NIT Tech? Because the interest is evident and for everyone to see.
Oh, morning, Samira. So I think what you've probably seen for the IT space as a whole, whether they are large caps or mid caps, has done exceedingly well. So I think we did like the large cap names within mid caps. We did like stocks like Mindtree, Cyient, and they have moved up significantly over the past few quarters. But what we really believe going forward, I think the value differentiator is going to be companies which are able to execute pretty well. And again, across the board, I think utilization levels have been pretty high. What you've probably seen in terms of announcements done by a lot of large players, and one is really expecting what TCS announces in terms of buyback. But the kind of payouts that they're giving in terms of their free cash flows are significantly higher. So again, I think if one leaves out Q1, Q2, where I think the wage hikes can have a say in terms of the rebate margins actually being a little bit soft. I think BFSI, retail, manufacturing, and the discretionary spending, US corporate tax cuts specifically for BFSI as a segment should augur well in terms of order flows from these companies. So at this point of time, considering valuations and assumptions of dollar and constant currency revenue growth, nuclear software from the mid-cap IT pack is something where my belief is that the earnings growth can be very strong over the next few quarters.
Well, 10 seconds to go as we gear up for market opening.
But coming on Infosys, Mayuresh, just to talk about a couple of factors here. Of course, completes 25 years on the bourses, has been one of the smartest wealth creators in the market, hit a fresh all-time high yesterday. TCS going for a second buyback. Is that now going to put pressure on Infosys to return more cash on to shareholders as well? Anyway, that's part of their plan. But do you think that will now accelerate the thinking process at Infi as well?
Well, Dipansh, I think if you look at what the management thought process has been, I think for Infosys specifically, 70% is expected to be as payouts of the free cash flows. Now, the expectations from what TCS might do tomorrow is something that is probably creating a huge amount of buzz for a lot of IT companies in terms of buybacks being announced. But a large element in terms of Infosys' performance over the last 25 years, it has been exemplary. It has fallen back over the past few years, but they are trying to recoup ground, specifically in terms of a lot of digital investments being done over the past few quarters. And you can actually start seeing them bear fruit in terms of performances from this sub-segment. As I mentioned earlier, BFSI is a core contributor, not just for Infosys, but for TCS as well, in excess of 31-32% respectively. And again, any revival on that front is going to be a huge value addition in terms of order flow. So I think the entire strategy that Infy is embarking upon, both in terms of the digital investments, the management changes that we've probably seen over the past few quarters and years, I think any stability and any turnaround on that front in terms of strategic decision making, which they have laid down in their vision document, would augur well. And the third element obviously is going to be the kind of execution patterns that they're able to probably do. So I think all these factors, if done carefully, I think the dollar revenue, constant currency revenue growth, which is lagging behind market leaders like TCS, they should start narrowing down. So large element of Infosys probably having a good show in terms of constant currency growth, barring apart, as I said, the wage hikes that you probably see and the EBIT margin compression or the softness for the first 2 quarters. The second half revival can be pretty strong for top tier companies. So the whole recommendation probably continues on stocks like Infosys and TCS.
Alright, so Mayuresh, I want to talk to you about 2 auto stocks. Give me your view on them. M&M has been the smartest outperforming auto stocks in the last 6 months after a long period of consolidation. Tata Motors saw a bit of a bounce back, but really no conviction buying coming in this one. Fundamentally, where would you place your bets?
So again, I think if given a choice between the two, I'll stick with M&M Dipanshu. Again, the kind of numbers that you've probably seen, specifically in its farm equipment segment and the expectations of 9-10% volume growth, specifically in its tractor business, augurs well for that sub-segment of its business. When you're probably talking about the utility vehicle segment, the expectations largely in terms of volumes being far better for this fiscal and the next is probably keeping the earnings profile of this stock on a consolidated or an SOTP basis very, very strong. What probably happens with Sayong is also going to be interesting in terms of launches out there and the kind of EBIT profiles that can probably be sustained at operating levels which are far more seener when you're probably comparing that over the past few quarters or years. Again, I think the kind of investments that they've probably done in subsidiaries that is bearing fruit to a large extent, that the return on capital employed in these subsidiaries is coming back in terms of dividends. So even if I take an SOTP value in terms of their core businesses and add to the value of investments in subsidiaries, our belief is there is potential upside even from the current level. The last month's data was a little bit softer, but again, I think one has to keep a larger term view in auto stocks. Tata Motors, I think the numbers are far more volatile at this point of time. The domestic story, specifically the mid-series story, is holding up, but the contribution on EBIT is far negligible when one compares the JLR's market share, both in terms of what they contribute on the EBIT front and the expectations largely in terms of what actually goes through both for the European and their American operations. So again, pick and choose at this point of time within this two. I think I'll stick my neck out with M&M.
Jay, Mayuresh, telecom is still a blanket avoid?
At this point of time, yes. I mean, I wouldn't say it's a blanket avoid, but what probably happens in terms of the down trading of ARPUs, that is going to still take a substantial hit in terms of the reported numbers. What I've actually seen in the past few quarters and the expectations of ARPUs actually bottoming out doesn't seem to be the case. So any aggressive plans like Jio announced yesterday with more freebies coming through in terms of more data being given, that will add volumes for the incumbents, because the incumbents will also come out with plans of their own, but that necessarily does not compensate data revenue growth. On the other hand, what you're probably looking at in terms of their capex plans, it is announced 24,000 capex. Idea might need to do capex, so the cost savings in terms of the merger with Vodafone is largely probably getting built in terms of both cost optimization improving over the next few quarters. And again, I think it's a 4 or 5 player industry with 2 of government players also getting chipped in. So I think a large element in terms of volumes, specifically data volumes, moving exponentially as we've seen is the case, but that is not substantiating into ARPUs moving up, which are actually going down. So I think it's a balance that one really needs to play off, and if one really starts setting off the kind of operating expenditure that these companies are expected to incur, The cash flows look seemingly weak for these companies. So I think it's a tough call for this sector at this point of time. I had been underweight for the last few quarters and years. But within this pack again, I think because Jio is part of RIL and RIL's other businesses expected to do well, along with the exploratory fields that it is probably showing a lot of interest at this point of time. My own sense is that Reliance is something that I'll continue to remain optimistic about, with a clear disclaimer that we do own the stock in our funds.
All right.
Mayuresh, how do you peg Reliance from here? Usually ahead of the AGM, we'll see the stock run up, maybe up until the earnings, the momentum will continue. Very typical in nature. Is that a given trade, easy trade here? Would you buy RL at 995? Seems like a good buy.
I think I'll give you the outlooks, and again, I think if you're talking about their core segments of petchem and refining, a lot of their projects which were underway over the past few quarters have seen the light of day. So you're basically going to see the EBIT margins of both petchem as well as refining probably getting stabilized as well as improving going forward. Now again, I think the GRMs, and when you're probably talking about crude prices being very, very volatile, Reliance does manage the cracks pretty well. So I think the GRMs that Reliance probably posts because of better management, and again I think better crack management, is somewhere where the premium of $4 for Singapore GRMs actually holds true for them. The third element in terms of their exploratory business actually going downhill, and the expectations of their partnership with BP getting renewed and revived is clearly going to be a feather in their hat, because I think as their capacity expansions start taking place, you're probably going to see far more volumes come through over the next few quarters. So very difficult to probably drill in what kind of numbers can probably come through, but there is an upside element on the exploratory front as well. Coming specifically on that telecom part, what they've probably done in terms of both the subscriber and the revenue market share has been quite significant. The kind of capex and the debt that they've probably taken on their balance sheet, not just for the telecom part but for their core businesses, I think a large element of their debt is probably behind them in terms of the core capex that they've done. For Jio specifically, I think the kind of operating expenses that they need to probably put through will start flowing through into their cash flows over the next few quarters. The subscriber base that they've got, the ARPUs that they report, in fact, is better than the existing incumbents at this point of time, and that's a very surprising facet of their business. So my own sense is that the ROEs should show marginal and a gradual improvement for the overall businesses, and that itself should keep the stock in good stead. So yes, I think I remain positive over a longer period of time, with a clear disclaimer that I put through.
All right, gentlemen, let's boil it down to final ideas then before we wrap it up. Gaurav, Himen, as well as Mayuresh, appreciate your time this morning. Thanks for taking us through your reading of the markets.